Hi everybody, hello and welcome to Thank God It's Friday, Boomer Quinn's weekly edition where we bring to you a market experts and this time around we're being joined by Saurabh Mukherjea, the CEO of Institutional Equities at Ambit. Thank you for your time, Saurabh. Thank you for joining us and we are going to be talking about your book, but first I'm going to start with the one question which everybody wants an answer to. What is your view on the equity markets, especially how are you reading the valuations in the backdrop of the current recent GDP data and the earnings growth that we have seen for this quarter?
So look, I think there's no real correlation between earnings growth and market movements from quarter to quarter. So I don't think we should necessarily try to link the two with each other. Around 4 months ago, we turned positive on the Indian market. We still have a target, Sensex target of 29,500. Clearly the markets have rallied radically. I think we were at 23,000 6 months ago. We're at 28,000 now. My reckoning is there's still some upside in the market over the next 6 months. I think the market still has around 5 to 10% of upside there. But the bulk of the upside really is now in stock selection. I don't think playing the index per se is going to make you a great deal of money here. The money to be made is in stock selection, and there the Ambit House view has been for the past 6 years that buy good and clean stocks, well-run, sensibly run companies, believable accounts, credible management teams, good cash generation. And that's the context in which also the book was written. But good and clean stocks, sensible investing is how you'll make money here, not necessarily by buying the index in India.
Okay, Agan, you have a question?
Yes, so my question was to do with the global environment right now, and everyone's talking about a lot of liquidity, but there is also Janet Yellen with her comments suggesting that there could be a rate hike sooner than later. In the backdrop, what is your call on the flows that we could see in India?
So look, I mean, what we've seen with India over the last decade is it doesn't really matter at one level whether the Fed hikes or doesn't hike. There's a core constituency of large long-only investors who are always interested in India. So, for example, we were hosting an event around Unusual Billionaires last evening, and there one of the world's legendary financial investors, J.C. Flowers, was speaking there, and he was saying at the book launch for last evening that they are very keen. J.C. Flowers, one of the world's mightiest financial services investors, is very keen to invest in India. He sees the economy in India having a fundamentally sound growth story, and he's interested therefore in putting money to work in India. That's been the case for the last decade or so. What can happen from quarter to quarter is some of the hot money, some of the hedge fund money might come or go, but I don't think your viewers should lose sleep about that. It's good for me to talk about it on TV that hot money will come and go and the index will gyrate. But for the fundamentally oriented average retail investor out there, just focus on the fact that we have a healthy economy with a core constituency of large long-only foreign investors who will keep investing in India, lending support to the market.
Right.
Okay, so long-only investors, you believe, will only look at any volatility which could potentially arise on the back of a Fed rate hike. So this should only be probably viewed as a buying opportunity, or would you rather wait and watch? What is your stance?
Yeah. So I think the reason it's worth reading The Unusual Billionaires and all candor is, what my experience in markets have shown me is there's absolutely no point, worrying about what the Fed will do or what the RBI will do and what this quarter's results announcement will be. There's zero value. It's good TV, but from a fundamental investing perspective, there's zero value in it. The main way you make money in any market, any equity market, is you buy fundamentally high quality stocks and you hold them for a long period of time. Right. Those are the two central tenets of equity investing success in any era, in any country. So talk to any of the gurus, whether it's in the West or in India, they'll say buy high quality names, hold them for a period of time. What I've tried to do in The Unusual Billionaires is turn those two tenets into an actionable strategy, where my point of view to the investors out there is look for companies which generate at least 10% revenue growth over a decadal period, at least 15% ROC over the same decadal period. Right. Buy these stocks and sit tight for a decade. You will make a lot of money, and you make these sums of money regardless of the year you're in, which quarter you're in, whether the Fed is hiking or not. So that's the way to think about it. It's, we can all read the daily newspaper, but it's best to take the newspaper and forget about the short-term noise and focus on the underlying fundamental issues which make some companies great and 99% of companies very ordinary.
Okay.
Well, just before we go and talk about your book more elaborately, I want to get this question out of the way, and this is to do with Reliance Jio. Is this pricing and all the plans with Reliance Jio, are they disruptive or destructive for the industry?
So in any industry, you get waves of comparative intensity rising, and then waves where comparative intensity abates. In the wake of the 2G report that the Comptroller and Auditor General published late in 2010, as you remember, then the Supreme Court then annulled whole load of telecom licenses. So 2011, 2012, 2013, comparative intensity in the telecom sector abated a little bit. Now clearly with yesterday's announcement, you will have a year, perhaps a couple of years of very intense competition, squeeze profitability. I'm not so sure that's necessarily the longer term trend. Telecom has been over the last decade or so a fast growing but very competitive sector. I think that's the way it will remain. What will happen is the more you squeeze profits out of the sector, the less money the government will make in the spectrum auction. So some of the knee-jerk reactions I saw to the share price, to Reliance Jio's announcements yesterday, reactions around, say, Bharti share price, Idea's share price. I don't necessarily believe that those are the long-term reactions. I think it will take time for the environment to settle down, and I wouldn't focus overly on the free this and free that announcements that were made yesterday. I don't think that's the steady state structure of the industry.
Saurabh, tell us, how long did you take to write your book? That was one question which really was I was wondering about that since a long time, and I also want to know, when you talk about a long term or a buy only, long only strategy, what should be a person's average holding period?
So my previous book, my first book, Gurus of Chaos, which was published around 2 years ago, that took me around 3 years to write, because I was the first time author then, and the whole process of signing a book contract, piecing together a coherent narrative took me a long period of time. Because I learned from that, this book, The Unusual Billionaires, from conceptualization to publication, is roughly a 2-year journey. But also because I've sort of learned from my first book, the second book has the merit of being a flowing read. I think the editors at Penguin did a fabulous job. They pulled together what is a lucid narrative. The intent of the book is to help the investors out there who as you yourself are alluding, get completely lost in this sea of interest rates going up, the rupee doing this, corporate announcement Y, right? And most of that is good TV, as I said, but it has very little to do with actual investing. Right. So the point of view I've tried to give to the investors out there is, keep it very simple. Look at basic financial metrics, revenue growth and return on capital employed. Take long periods of time. I look at the 10 preceding years, basic metrics, look at long periods of time, and then once you invest in those stocks, sit tight for a decade. Right. The astonishing thing about India is that this is a country where, even though in the 25 years since liberalization, the economy has, I think, pentupled in size, the way our financial markets work still remains very inefficient. Right. So if you buy fundamentally high quality companies of the sort highlighted in the book, and you sit tight for a decade, you'll compound it around 22-23%, which is a lot of money. You basically make 10x your money in 10 years' time, provided you show the necessary patience.
Sort of, why these two criteria? So 10% revenue growth and 15% ROC is what you've spoken about in your book. But what about the other criteria, like dividend payouts or corporate governance? Why did you choose, or how did you finally select these double filters?
So what you want is to capture two facets of corporate life. One is, you want to capture an element of growth, right? Because franchises which grow bigger obviously give you more money. But secondly, you also want to capture protecting or guarding a franchise, right? You need, at any point in time, whether it's in our daily life or in corporate life, we're doing two things. We're trying to move forward, we're trying to grow, but we're also trying to hold on to what we have, right? So revenue growth captures the growth element, ROC captures the ability to protect, to moat the franchise. It also happens conveniently that ROC, the EBIT piece and the denominator, capital employed piece, captures a whole lot of other elements, such as cash flow, working capital, profitability, which are necessary elements to corporate success. So by combining revenue growth and ROCE, you actually pull in everything that we need to pull in. In two simple metrics, you pull in everything that is relevant to understanding corporate success. And then by using a 10-year period, you're basically factoring the economic cycle in. Remember, over a 10-year period, you have a mixture of a recession and a boom. So therefore, you're evening the cycle out, and you're taking a 10-year perspective. The interesting thing is, those metrics, simple as they sound, 10% revenue growth and 15% ROCE, there's barely 15 to 20 companies which pass those metrics.
I found
in
that
India.
surprising. I really did find that surprising. Out of 5,000 companies and 1,500 companies which have a market capitalization of 100 crores, well, that was certainly.
So I'll tell you something else which was stunned us even further. I haven't put it in the books, so for those who are watching, this is a bonus.
Okay.
If you take a 20-year period in India, if you take the last 20 years in India, and you use these two filters, 10% revenue growth and 15% ROC, not one Indian corporate passes the 20-year filter. Right? The closest corporate, and remember there are 5,000 listed companies in India, not one passes the 20-year screen. The closest company to come to that 20-year filter is Asian Paints. They pass the filters in 19 out of 20 years. And as I highlight in the book, in the second chapter of the book, Asian Paints is the Don Bradman of corporate life in India. What Don Bradman was to cricket, Asian Paints is to corporate life. And there's one chart in the book which I'll try to show here, which sort of made writing the book worth its while. So in the second chapter of the book, there's Exhibit 9, right? And this is Exhibit 9. And I learned more from this one chart than I probably learned from the last 5 books that I've read, right? Because what that's telling me is that this incredible company, over the last 60 years, this incredible company has compounded revenues at 20% per annum. Over the last 40 years, its profitability has improved. And over the last 30 years, its return on capital employed has improved. Forget about India. I doubt there's any company anywhere in the world which has produced this sort of result over the last 60, 70 years. So the benefit of this approach, where you're taking a longer term perspective to understanding corporates, is you identify outstanding franchises who are then able to compound your wealth in the next decade or so at a frenetic rate, 10x in 10 years. Right? Day trading is not going to get you there, and obsessing about when the RBI will hike or not hike is not going to get you there either. By backing companies such as this, you're more likely to get there.
Well, Saurabh, there's another question that I have for you, and you have mentioned it in your book. This is to do with tight-fisted promoters who are reluctant to give management more powers, more authority, as against other managements. For example, in this case, if I can take Marico's example, the promoter has given absolutely everything away to, the professionals. According to you, what roles should each play, for promoters and the management?
So, super question. I think what we are increasingly seeing in India, and I think this is evident elsewhere in the world as well, is that the day-to-day operation of a company is best left to executives. So, what should be the pricing policy, what marketing plan should you launch, which geographic areas to enter, whether to do brand extensions or not. Those sorts of operational decisions are best left to the executive management team. The promoter's forte, his strength should be capital allocation, and to the extent it's required in India, the interface with the regulator / political community. Unfortunately, interface with the politicians still remains still a necessary aspect of corporate life in India, and the promoter is the right person to do that because he's the owner of the company. So capital allocation, political interface should be the promoter's forte. The executives should be left to run the company. They should be the specialists in marketing, training, recruitment process, that entire piece. That demarcation works very well. It also works very well we've seen in the American context. So there's a lovely book, if someone wants to read about this in the global context, there's a book called The Outsiders by a guy called William Thorndike. He highlights this demarcation beautifully in the American context. I have tried to do something similar in the Indian context. As you said, Marico, an Asian Paints, a Berger Paints, they're handing over the charge of the company to the executives. The promoter is saying, my main job is to help you allocate capital in a rational manner.
Okay, so promoter plays an important role, but you need to hand over
The reins to the management.
to the people who will do it the best. I want to name, there are 7 companies that Saurabh has mentioned in his book. You have Asian Paints, HDFC Bank, Axis Bank, Marico, Berger Paints, Page Industries and Astral Polytech. Now, what I really noticed, Saurabh, is that all of these are your retail, consumption-related, defensive kind of stocks. They all fall into that bracket. What I wanted to understand is that would that really imply that commodity stocks or cyclical stocks are not going to be outperformers over the long term? Because they are of cyclical in nature, or will they not generate wealth for a long-term investor?
So I think, look, I mean, it's a very interesting question that it is, and I think there's also, if you pardon my saying, there's also a misperception embedded in that question. In most countries, banks are very cyclical, right? So the fact that in India, some banks are not cyclical, HDFC Bank in particular, is a testimony to their quality of management. Banks are necessarily supposed to do really well when the economy is booming, suffer when the economy is in recession. But the fact that HDFC Bank doesn't do that is because it has outstanding management qualities, outstanding capital allocation. Secondly, it's not all the franchises are retail. A big part of HDFC's book has commercial in it. More specifically, Axis Bank. The majority of Axis's book is corporate lending. You could argue Axis has suffered by dint of that in the economic downturn, which they have. Right. But in spite of that, if you look at Axis over the last 15 years, they're compounding at mid-20s. So mid-20s compounding for a commercially focused bank in India is outstanding. I mean, at one level, Axis's success in that regard is even more laudable than HDFC Banks, because HDFC Bank has quite rationally said, I'm not going to take too much corporate risk. Then we come to the more fundamental issue raised, which is a fair one, that hey, if you buy commodities, you buy real estate, construction stocks, steel stocks in India, you're not going to get these sorts of returns. And you're right, you won't. The reason for that is the cost of capital in our country is high, right? Historically, in the last 10, 20 years, the bulk of our savings have gone into gold and real estate. And as a result, financial markets haven't really received the bulk of Indian people's savings. As a result, the cost of capital is high. If in a high cost of capital country, you go into capital intensive sectors like steel, real estate, construction, obviously it'll be difficult for you to generate shareholder value, which is why those sectors haven't made money for retail investors, or for any investors for that matter. And my point of view for investors out there is, if they don't make money, then there's no compulsion forcing you to go and buy stocks in the sector. Focus on sectors where cash generation is high, and the company itself is throwing off so much cash that they've got resources to compound your wealth in the years to come. So a professional fund manager might perforce have to have some real estate or steel exposure. The viewer of this program doesn't need to have that and shouldn't therefore have it. His or her money, my money, is valuable. I want to put it where I can maximize the returns from it.
Right.
Okay. You've also mentioned about HDFC Bank and Axis Bank, and you've highlighted or written about how these companies have tackled challenges over the years and transformed themselves. But my question is that this is based on historical or past data. How does a person identify new growth stories or new unusual billionaires in the making? So my question really is that how does one, for example, do you believe that any new age private sector bank is, on the way to becoming the next HDFC Bank? How would you identify some of these newer stocks?
So two levels at which I'll try to answer the question. The first is the future is unknowable. It's just as unknowable for me as it is for you, as it is for the people watching the program. So if it's unknowable, there's no point trying to predict it and trying to behave as if I know it. I might get it right once or twice, but fundamentally, consistently, I'm not going to be able to get the future right. And anybody who claims he can or she can, you got to be a little skeptical of that. Since I can't predict the future, I should look back as far back as possible, right? I don't know what the future will bring. I got to look back as far back as possible, identify companies which have a great track record, and then say that given the track record, do I believe the track record can be sustained going forward, right? So if I, for example, identify 15 companies which have a great track record, I might sit here and say, hey, although there are 15 here, only 10 might sustain that, because in the other 5, new entrants are coming in and they're whacking the margins down, right? So that to my mind is the most sensible way to invest. You look back, identify high-class companies, and then by a process of elimination, you knock off a few of them where you believe there are obvious disruption threats, right? The second piece is that if you look at India, at any point in time, there are barely 30 companies which are investable, right? It's a tragedy, but it is what it is. Of the 1500 or so companies with 100 crore or more market cap, of the 1500 or so sort of superset of companies, there are barely 30 companies which are doing a good job of putting money to work, their money to work. Therefore, to assume that suddenly from outside that superset of 30, new challengers will emerge is also a little bit over optimistic. It rarely happens. If you see the if you see appendix 2 of the book, where we have recreated coffee can portfolios going back 15, 16 years, you can see that the names are very similar year after year, and you can also see that this strategy has delivered for 16 years now. In fact, every single year, the coffee can strategy, and just to reiterate what the coffee can strategy is, you're looking back the previous 10 years, revenue growth 10%, ROC 15%, you're identifying the stocks, you're holding them for the 10 decades. Every year for the last 16 years, the strategy has delivered substantially better than the Sensex returns at lower risk levels. So if it's worked in the past, there's reasonable grounds for believing it'll work in future, and that's what I'm telling the retail investor out there to focus on. It's like the difference between modern medicine and quackery. We can believe quackery; it sort of gives us, a hope that if I have something which is unconventional medicine, alternative medicine, I might suddenly get better. But the science is in favor of conventional modern medicine.
Okay. So there are also some names like Sun Pharma, Infosys, Bajaj Auto. Some of these have created tremendous amount of shareholder wealth over the past few years. Of course, they did not clear your criteria or double filter that you had of revenue growth and ROC. So are these not good businesses, or do you feel you've missed out on any such names?
Actually, I want to add to that because there's a viewer question, and they also add that why are there no IT companies in your coffee can portfolio? This question is from Jayant Nanjappa, and he also asks why wasn't ITC covered in the book?
So let me answer the easier question first. Why isn't there IT and some pharma companies? You mentioned Sun Pharma. So the viewer out there, I would refer you to chapter 1. What I've tried to do in chapter 1 is address some of these issues. If this criteria of 10% revenue growth and 15% ROC is actually very demanding, and the only IT company which really sort of made it was Infosys. In Infosys's case, the reason I didn't include it in the book, and I say this specifically, on page 25 of the book, that as I say in the book, Infosys's sales growth went from 5% in FY10 to 24% in FY14 and dropped back again to 6%. Since my criteria says at least 10% revenue growth, the drop off in sales growth for Infosys unfortunately disqualified it from making it to the book. There are two pharma companies which just about made it to the book, but then they fell short. IPCA, the ROC halved from 28% in 14 to sub 15% in FY15. So again, remember 15% is my cutoff. Because IPCA, due to a bunch of FDA challenges, the ROC plunged. Unfortunately, I had to take it out. Remember, again, the 15% threshold on ROC is sacrosanct, right? If you breach it, I can't have you in the book. So IPCA lost out, and Cipla, similarly, major ROC plunge in Cipla over the last 3-4 years with disqualified Cipla. Sun Pharma surprisingly doesn't actually need the filters over the last 10 years. So then let's come to the other point you're raising, that hey, do you have to meet the filters to make money? No, you don't have to, right? Kotak Mahindra Bank, for example, doesn't meet my 15% filter. Motherson Sumi doesn't, right? They've made money. But you can't, if there's no point inverting the question saying, let me look at people who have made money and let me see if I can buy them, because that's the genuine bias, look back bias. What I'm saying is, I want to identify companies who consistently have the basic techniques of shareholder value maximization right, then I'm betting on them. So the difference is, to use a cricketing analogy, I want to identify players like Rahul Dravid, classical technique, right temperament, the right mindset and the right grit for outstanding cricket success, and then I'll back them. I'll back them and say, look, I'll bet on your career. What I don't want to do is watch the latest IPL, watch a player having a couple of good IPL seasons, and go to them and say, you had 2 great IPL seasons, let me back your career. So I'm looking for people whose fundamentals are solid, rather than people who had a great few years, because the latter is where I could get trapped. Whereas the former, if I get my fundamentals right, I'm much more likely to back a player who will become a legend.
Okay, so good quality names are good irrespective of their price or valuation. That's what you are saying. For a long term, a good company remains a good company irrespective of the price.
I do say that in the book implicitly. I haven't said that in the interview just yet, but I do say that in the book. Clearly, you guys have read the book, which is actually delightful to see people having read the book. Yeah. So the other point I do try to make in the book is that beyond horizons longer than a year, your entry period valuation doesn't matter. Right? If you're a quarterly trader and you're obsessed about your quarterly profit, then you should worry about valuations. But if you've got a horizon longer than 12 months, there is layer after layer of evidence that your entry period valuation is not something you should lose sleep over. Right. So in the context of the book, several of the legendary companies mentioned in the book optically appear expensive, right? And a lot of people ask me, should I really be buying the 7 companies mentioned in the book? Some of them are really expensive. And my point is that that's been the case for a long time with several of these companies. And yet, they have compounded wealth at a breakneck speed over the last decade, in spite of being expensive a decade ago, right? So for fundamentally oriented long-term investors, quality is your holy grail. Focus on that. As soon as you bring price into the picture, you're trying to straddle two very opposite sort of planks, and there's risk you fall down the middle. Right. If you're a long-term investor, focus on quality, don't lose sleep about price.
And Saurabh, I'm sure timing matters, as you said, for a long-term investor. If your holding period is going to be anything more than 12 months, if that's the...
I'm saying pricing doesn't matter, timing matters. So timing matters in the sense that you have the patience to hold stocks for a long period of time. Timing doesn't matter insofar as it doesn't matter whether you buy it at a PE of 35 or 30 or 27. If you're buying a legendary franchise, it's highly likely it's very expensive, right? It's unlikely that you're the only person in town who's figured out that this is a legendary franchise. But there is no great information value in knowing that the stock is expensive, right? There's no sort of merit in knowing that Rahul Dravid's stress average is 57. Rahul Dravid's stress average was 57 halfway through his career. Even in the next half of his career, he still compounded runs at 57. Right? It didn't make him any less a player. So Asian Paints, 75 years into its existence, having compounded at a frenetic pace, close to 25% compounding over 75 years. By the way, that's longer than India has been independent almost. Right. Asian Paints, having done that, will still compound for you at a very healthy clip in the years ahead. It doesn't make sense to look at its valuation and say it's expensive, I'm not going to buy, because it's like saying he'll make money for me but I still won't give him the money. Do you see where the valuation trap kicks in? It's an optical trap and it's very easy to fall into it. Right. Saying that Asian Paints is expensive, I'm going to avoid it, or Page Industries is expensive, I'm going to avoid it, because you then walk straight into lower quality names who do not have the underlying compounding engine quite in place.
Okay, so timing does not matter. Yeah, that's what Saurabh is saying. As in, for example, even if I was if there was an investor who invested at the end of 2007 or beginning of 2008, he would probably he would have probably got back what he wanted. But the whole point here is that either ways, irrespective of how the overall markets do, that stock would have outperformed it if it was a good quality company. So, can I say that? Is that what you mean?
So timing doesn't matter for long-term investors. I'll illustrate that using another exhibit from the book. So page 21 of the book, is exhibit 6, right? And I've shown there 6 completed coffee can filters, i.e. coffee can portfolios, which have completed a 10-year run. The really interesting filter to look at is the 2000, the really interesting portfolio, is the 2000 portfolio. Okay. Remember, the 2000 coffee can portfolio begins in June 2000, right at the height of the dot-com boom, right? And it ends in June 2010, right? So it's 10 years, and you tell yourself, hey, if it began in June 2000, right at the height of the stock market boom, surely, it would have given weak returns. And yet you can see that portfolio, the June 2000 portfolio, compounds at 19%, and outperforms the Sensex by 5%, 530 basis points over 10 years. So if you ever needed convincing that your entry period doesn't matter, just read the book, look at the portfolios. In appendix 2 of the book, great amount of detail is given on these portfolios. The fact that you could have bought a portfolio right at the top of the dot-com boom and still compounded at 19.3% in the subsequent 10 years gives you a lot of comfort that this method works. Buying high quality, albeit optically expensive names, sitting tight for 10 years works. The reason it works is the compounding in earnings, compounding in book value more than overshadows whatever price you paid at the outset.
Okay, all right. So a good company will always outperform, is at least that something that we can safely take away.
Saurabh, I also wanted to ask you about, actually I was just going through some of these quotes and I came across one by Bill Gross and he was describing Peter Lynch, where he says that he knows a guy, he knows how, he thinks that Peter Lynch will know when to exit. Now, one of the appendices in your book also mention not churning. And on the other hand, there's also this thought belief that you should be keeping your stocks for a really, really long time, as long as you can hold on to if they're good quality stocks. So, how do you address this?
So we all live and learn. So in my first book, right, which was interviews with 7 fund managers who I sort of regard as my gurus in the Indian context, and hence the name of the book, Gurus of Chaos. When I reread my own book, right, what struck me was almost half of the 7 or 4 out of 7 fund managers in those interviews which are in Gurus of Chaos, 4 out of 7, and these are legendary fund managers. They are the Peter Lynches of India. They're the sort of smartest, brightest people in the Indian market. 4 out of 7 said that the hardest thing in their career was knowing when to sell. Right?
Exactly.
And in fact, 2 out of 7 said, if I look back at my career, 2 out of 7 said, if I look back at my career, my biggest mistake was selling some of my best stocks too early. Right? So I think one of the fund managers, the last interview in that book is the fund manager who used to run my money till he retired 3 years ago. So he said that, look, I sold Titan too early. I sold HDFC Bank too early. And then I regretted it as I watched those companies fly away. And I sold them too early because I got lost in this optical PE, PB game, right? So I then reflected on it and I told myself, if these guys, the best in the business, the legends of our trade, cannot figure out when to exit, what hope does the average guy watching this program have? Therefore, to the extent we have to sell at some stage, we don't know when to sell, we might as well make the sell decision automatic rather than try to time it. And hence my coffee can portfolio, where you buy, put the stuff in a coffee can, which is where the analogy comes from. It's an American analogy. You stick the stocks into a coffee can, metaphorically, of course. I'm not suggesting you take the demat account and stick it in the coffee can. You buy the stock, stick it in a coffee can, and open it 10 years later and sell the stocks. So you're making the sell decision automatic rather than sitting at night and saying, should I sell my portfolio tomorrow morning? Because the legends are telling us it's very hard to do that.
Okay. We have a viewer query and they're asking about which sectors or themes are catching your attention right now. So anything that, any specific sector or theme where you're seeing value right now?
So I think there are 3 things which are clearly happening in India today, and for those who want to sort of take a more creative approach to investing rather than the unusual billionaires approach. There are 3 things which are happening in India which you can try to invest in. It's not easy, but you can try it. The first is clearly there's a massive squeeze on black money, right? And I travel extensively to small town India, whether I go to Patna, Varanasi, Allahabad, Aurangabad, Coimbatore, there's a massive squeeze on black money. And it's reasonably clear that real estate and jewelry or gold are casualties of this. And a lot of that money will come into the financial system. And I think when it comes into the financial system, smaller banks, private sector banks will do well, smaller lenders, NBFCs could also do well. But also consumption will get a blast, right? Consumption will boom because some of that black money savings, in fact, a lot of the black money savings could potentially become consumption in higher end cars, higher end, consumer durables. A lot of business people who have black money are doing up their homes. So there's a big shift towards saving through black money into either saving through white money and or aspirational consumption. The second big trend in India, clearly visible, is the big decline in public sector banks. They don't really have the money to lend anymore. And as a result, big market share gains, rapid market share gains for private lenders, whether they be banks or NBFCs. Again, a whole gamut of well-run private sector lenders, banks and NBFCs that you can invest in. It allows you to play the consumer credit theme as well. As consumers spend more money, they will borrow more as well. They'll borrow for washing machines, cars, electrical items, etc. And consumer credit providers can play that theme. The third trend, I think, is the slow but sure, almost guaranteed decline and death of Indian railways and the migration of freight from rail to road. So if you see, the railways is consistently having to cross-subsidize freight. They charge high prices on freight so that they can keep the passenger fares low. But at the same time, diesel prices are down, roads are getting better, trucks are getting more powerful. So road freight is dropping sharply in price, and freight is migrating. So roads is a big opportunity, trucks is a big opportunity, truck financing is a big opportunity, and many different plays around that. These are the three trends I think you can play out there. There are stocks associated with each of these. For compliance reasons, I can't name them, but I'm sure your viewers know what these stocks are, and perhaps that they can also judiciously choose good and clean companies associated with these themes as well.
Right. So, well, actually, we had viewer question exactly on that. It was Avinash Reddy who also asked whether or not tight norms on black money will bring more investment in real estate and gold. I hope Saurabh has answered your question, but I'm going to move on then. Saurabh, you have mentioned William Thorndike earlier, and you also mentioned John Kay in your book. Can you tell us a little more about these two guys?
Sure. So William Thorndike's book was referenced. William Thorndike's book, The Outsiders, was referenced by Warren Buffett in, I think, the Berkshire Hathaway 2012 or 2013 annual report. If I get exactly which one of those it was. It's an outstanding book, really worth reading. So whilst I would love you to read my book, you might also really want to read William Thorndike's book. One of the best business books to come out in the last decade or so. What he does is he identifies, I think, 7 American companies who've outperformed GE by a big multiple, I think 20x or something in the last 30 years. So remarkable performance. And what he says in a beautifully written book, what he highlights is that in those 20 companies' case, the central trait that the CEO or the promoter showed was the ability to allocate money rationally, clinically, coldly over long periods of time. So go into one business, build that business up at a full valuation, sell that business, move on to the next business when the valuations were low, build that up, right? It's a great book to read. I'm not so sure how directly applicable those skills are to India, but it's an outstanding read on how smart promoters think about capital allocation. John Kay is the person who taught me most of what I know. He was my first employer after I graduated from the LSE. I then set up my own company when I was 27, and John very kindly invested and became the chairman. So I continued learning from him, and even now he writes in the Financial Times. So I write to him, he responds back. Once a year we sit down for a long chat. I've learned a lot from him. Specifically, what I've learned from John is how to assess great franchises. So John has a framework called innovation, brands, architecture, and strategic assets. His view is that a company's sustainable competitive advantages can be assessed using the framework. So in the same industry, 2 truck companies, one truck company can pull away radically from the other if it is able to come up with better quality trucks, better distribution, better marketing, better training processes for its staff, better branding processes, and thus, given identical business conditions, one truck company can generate 12% operating margin, whereas the other truck company will be barely breaking even. We have that reality in India today, and John Kay's framework allows you to rationalize that. So I've made lots of copious use of John's formulas, of John's frameworks in the book, and Appendix 1 describes John Kay's work. If you want to read the master's own work, there's a website called johnkay.com, or you can buy his classic Foundations of Corporate Success.
Right.
There's a chapter on that called Sustainable Competitive Advantages.
Yeah.
That chapter has formed the spine of my career. The one chapter of John Kay's career has been the spine of my career, gives you a sense of how much more the man can do. And William Thorndike's way of thinking about the world is very interesting, and I think there's a lot to learn from that as well.
Yeah.
Okay. One more question. Okay.
From Uchit Shah, and he's wondering why you aren't on Twitter.
Okay. So what happens in our job is we need to read a lot. So I travel a lot because I have to go and meet not just corporates and fund managers in different parts of the world. I also travel to learn about India. So last weekend I was in Allahabad and Varanasi because otherwise you don't really know what's going on. Sitting in Bombay, we're in an echo chamber, right? I'm telling you and you're telling me, but we don't really learn that much. So unless I go and travel into the countryside or into smaller towns, I don't learn. So what happens then is, if you're traveling a lot, then there's very little time to read. If you don't read, you can't grow as an individual. So if you want to travel and you need to read, and you also need to spend time with the family, you need to minimize every other form of distraction.
Right.
So what I've tried to do is completely kill distraction to the extent I can. So whether it's my own social media accounts, I don't do it with friends or with clients. I just try to minimize two-way interaction to as much of an extent possible, because I need to use that time to think. I would love to do more on social media, but perhaps that'll have to wait till I retire from my current job.
Okay, great, fine. Just one more question which I had on my mind. Now, Urjit Patel takes his office as the new RBI governor this Monday. Previously, you had said that you were not surprised by Raghuram Rajan's exit, given that his thought process did not match with finance ministries. Any expectations when it comes to Urjit Patel?
So look, I think as Urjit Patel himself has said in his own extensive commentary in the past, he's an inflation hawk. He believes inflation in India needs to be kept in check. Urjit Patel has played a central role in creating the MPC framework in India, the Monetary Policy Committee framework in India. So I'm sure on that front, he'll be reasonably predictable, i.e. he'll take a hardline stance on inflation. And I doubt in the next 6 months we've got more than one rate cut coming, whether it was Raghuram Rajan or Urjit Patel. I think the views on inflation appear to be very similar. Where I am completely in the dark, I have to confess, is what Mr. Patel's views on the banking system are. So as we all know, our banking system is in a mess, specifically as we discussed on the show already. The PSU banks seem to be on a downward spiral to doom. What exactly can be done about that, I'm not so sure. Remedies don't appear particularly obvious to me. And since he's a new broom, I suspect there might be some major announcements in the next few months on the banking front. Unfortunately, I don't know what those announcements will be, but that in a way is the big unknown. Our banking system is in really bad shape, and the new governor's ability to fix it or lack thereof will have a major implication for the economy in the next 2 to 3 years.
Any question?
Oh, but there is another viewer question, and it's Avinash Reddy again. He asks, why aren't there any mid-cap or small-cap companies in your list? Well, Saurabh partially has already answered that one, that they probably don't go through the filters that he has used, but there is one mid-cap company in his list. Would you want to talk to us about that, Saurabh?
So yeah, so Astral Poly obviously is in the book as a very credible mid-cap company. It passes the filters, and Sandeep Engineer's story of losing almost everything he had twice over and then becoming an unusual billionaires in the book. But what viewers can also do is Appendix 2 of the book gives you all the coffee can portfolios, and in particular in page 421, Exhibit 189 gives you the latest coffee can portfolio as of June 2015. Portfolio, and you can see it on the screen. You can see the names of the companies on the coffee can portfolio. There are around 20 odd companies in the June 2015 coffee can portfolio, and there's a fair mix of mid-cap names there. I can see some very prominent mid-cap names there. So if you have a penchant for small and mid-cap investing, then Appendix 2 will give you plenty of names to chew over and mull over.
And finally, we have a segment on our website. It's called the Library of Leaders, and we want about 3 or 4 books that have always been with you. I know you probably mentioned some of them, but what would they be?
So I think Foundations of Corporate Success, as I said, has been a sort of defining influence on my career. And in one specific chapter, the Sustainable Competitive Advantages chapter has been the spine of a lot of what I do in my professional context. But 2 other books to read, which I think are very, very useful for in many different contexts of life. If you want to understand how India works in one book, right, then the book to read is V.S. Naipaul's 1989 book. It's just as relevant today as it was written in 1989. It's called India, A Million Mutinies Now. Right, 1989, 1990 published. It'll feel, when you read it, it'll feel like it was published yesterday. It's an incredibly interesting book, beautifully written. It'll help you understand how India works, right? Astonishing book, legendary book, classic book. And for someone, if you want to learn how to, articulate complex arguments, whether it's in a program like this, or it's in a book, or in a memo at work, then there's a book called The Pyramid Principle, written by a lady called Barbara Minto. The first 105 pages of the Pyramid Principle are just divine, right? In 105 pages, she tells you how you can articulate the most complex arguments in the simplest manner in the most difficult circumstances. Right. So Pyramid Principle, Foundations of Corporate Success, India, A Million Mutinies Now. 3 books which have had a big influence on my life and my thinking about the world.
Right.
Okay, so that leaves us with a lot of.
Do we have just one viewer question?
Sure.
Just one. Well, this is it. So Jinson George wants your view on the aviation stocks on a long-term basis, especially Indigo Aviation. I'm not sure if you can talk about that, but
Aviation overall.
Aviation.
So look, I mean, it's a sector that It's present in almost every large economy, and in every large economy, the challenges are identical. Barriers to entry tend to be modest, and as a result, on a cross-cycle basis, it's very difficult to make healthy return on capital employed. Obviously, capital-intensive industry, but the bigger challenge is to generate a return on that capital is hard because entry barriers are low. So you're seeing that in India already, because fuel prices are low, airlines are making a bit of money. But as soon as airlines make a bit of money, 3 new guys come in, crush profitability for the incumbents, and share prices sag. So tough sector to invest in. There's only one airline globally which seems to have defied the norm, Southwest Airlines. Maybe someone else in India will defy the norm, but as I said, I'm a skeptical guy, and I try to focus on the tried and tested rather than the new and speculative.
Okay, so past performance is indeed the indicator of future performance. That's the thought that Saurabh is leaving us with. And we also have a host of books that will keep us busy over the weekend.
Absolutely, yeah.
So thank you for joining us. Thank you for watching Bloomberg Quint. And yes, we will be back at the same time for thank God it's Friday. And yeah, we'll see you back on next Friday. Thank you for watching Bloomberg Quint.